Hey there, Melissa. Thank you very much. Yes, indeed, as you said, I'm here with the chairman and CEO of Goldman Sachs, Lloyd Blankfein. Good afternoon to you. Thanks very much for joining us.
Oh, thanks for having us.
I want to start with a view on the economy stateside in particular. Yesterday, we had Warren Buffett on our air, and he said that he did not think Donald Trump had yet had much effect on the economy. Do you agree with that?
Well, I think he's had one effect. I think he's raised expectations that there'll be positive change towards stimulus. Look, they'll either, if he's successful, there'll be a lot of it. If he's unsuccessful, there'll be a little bit of it, but there's not going to be none of it. And it doesn't feel like it's going to go backwards as it might have. I'm talking strictly about stimulus here. If he hadn't got elected, and if instead of the current program, we had a program that called for more regulation, higher taxes, and I guess both platforms called for more infrastructure spending. But certainly the platform, Trump's platform, is stimulative on those grounds, so he'll be more or less successful. So there's got to be some more stimulus than we would have had.
And that view of delivering 3% real GDP growth for a sustained period, is that achievable in your eyes?
Well, I'm not going to contradict Ben Bernanke per se, but I think that the economy could grow at a faster rate than it's growing. I think our expectation is going to be plus or minus around 2%. So I don't know whether that's 2.5% is the goal or 3%, but I'm not going to fight with that.
And if we switch from the economy to the market, valuations relatively full at the moment, volatility very, very low.
Yes.
Do you think we're priced for perfection somewhat at the moment?
Well, every time I get accustomed to low volatility, like we were towards the end of the Greenspan era, and we think we have all the levers under the control, and there's low risk in the world, and the world is awash with liquidity that pounces on every aberration in the market, so things go in, something erupts to remind us of our that idea that anybody is in control of anything is hubris. And the world doesn't perform like that for long periods of time. So I don't know what brings us out of the doldrums, but my expectation is that this is not a normal resting state.
And I mean, you mentioned the Greenspan era. You've been through and overseen lots of cycles. So are there warning signs that you're looking at the moment that are flagging to you, or not?
Well, I say not a lot. Not as many warning signs as will be available to me in hindsight after there's a problem. And I will swear to you, and I will really think I saw them. But I would say, in prospect, I'm much better at predicting the past than the future. I would say, if I had to look for anything specifically, I would say asset prices are high, but a lot of asset, like real estate, some of those have slowed up, and some of them have come down. Credit is very tight. So I would say distressed credit as people search for yield. I could say, maybe in hindsight, it will appear that a lot of the move into equity, and specifically passive equity, is based on the idea that equity is all correlated, that individual companies don't matter, industries don't matter, because we're looking at a yield in dividends, and normally associate yield with fixed income and not with equity, where you think of returns. But people are plowing money into equities because the dividends are higher than the interest that some of these companies are paying. That may be evidence of a bit of a bubble. The low volatility itself might be a kind of bubble of confidence, but we won't know until we know. My own expectation, which I never rely on. Look, I always differentiate forecasting. What do you think will happen from the exercise of risk management? In risk management, I don't care what anybody thinks. I don't care what I think. I'm just preparing for contingencies. On the other hand, in our trading businesses and trying to anticipate flows and what clients want to accomplish, there I have to try to guess the future and where things are going. So those are two different exercises. My own view from a market positioning point of view is that we're muddling through. A lot could go wrong, but I think the base case is that things are going right.
In terms of preparing, I suppose the banking sector as a whole is far more prepared than it used to be. If we move the conversation on to possible deregulation, do you think the US banking sector is overcapitalized at the moment?
I do. Look, the system had a very, very big trauma, and we legislated very quickly. There was a lot of demand for it. And the issue was, what should we do? Should we regulate capital? Should we regulate liquidity? Should we prepare for these things not working and have tests for how people will respond in case there's a crisis or a resolution, the call for resolution? There's even a test, there's even a regulatory overlay that tries to divine your state of mind, why you took on a position, namely the Volcker rule. Which of these should we do? Let's do all of them.
Right.
The net effect of layer on layer on layer is that every increment and every layer provides less incremental safety and soundness, but more of a burden on risk-taking and doing the very things that a financial system is supposed to accomplish, like taking on certain risks so that companies and individuals can deploy their capital and without fear of a certain kind of risks that banks would take on for them. And so now that the trauma has ebbed a bit, we should learn the real lessons of the past, but I think some of the, and I'll say overreaction, I know people will be critical of that statement, but you can always draw out incremental safety, but it only comes at a cost. And I think now this distance from the traumatic events, people have to take account of the costs.
And if capital rules were somewhat relaxed, what would you do with that capital? Would it be straight back to shareholders or reinvested elsewhere?
Some of it would be reinvested, some of it might go back to shareholders, but I don't think there's that big a dichotomy from a point of view of public policy and the right thing to do. Look, if I saw ways of investing in our business and earning a high return on that, then I should invest that money. But if I don't see it and I return it to my investors, what do? They take that money and reinvest it in places where they think there'll be a higher return. One way or another, that money will be reinvested. If I don't exercise that judgment for my shareholders, it's their money, let them exercise it. So I know some people will say, well, if you allow people to dividend more, return some money that's overseas, return that to give it to the companies or forgive some tax that might otherwise be due, it'll only return it to their shareholders. I say, yeah, and the shareholders will then invest it where they think the returns are the highest, and that's very a positive effect for the world.
You briefly touched on Volcker a moment ago. I mean, did prop trading itself cause the financial crisis?
No, it didn't, but I could understand. Look, when you go out and re-regulate the system, I don't think you should be stopped and just address those issues that were the precise cause of the financial crisis. The cause of the financial crisis was a calamity in the real estate market. 90% of all the losses were attributable to real estate, whether it was in the form of derivatives or cash or CDOs or structured instruments. It was a real estate bubble that collapsed. Doesn't mean I can understand and I'm sympathetic to the idea that certain institutions that get certain benefits in terms of being able to acquire certain kind of financing on a guaranteed basis shouldn't deploy that for strictly proprietary purposes.
Yeah.
But they should be able to be principals because market making is a very important public function of companies like ours. And if we don't do that, the drop in liquidity will not allow other people and industries and other investors to accomplish their objectives, which are beneficial for the financial markets. And so,
it's something you'd like to have more flexibility.
So there should be that more flexibility.
In terms of the possibility of ring fencing coming back, do you think investment banks and commercial banks should be separated?
I think that the eggs are out of the shell and an omelet's been made. We are probably, and this has been pointed out, we are probably the large bank that's best positioned for a return to Glass-Steagall because we're not a universal bank. We have some of those functions, but very minor in relation to our investment banking activities. And so our adaptation to that would be relatively easy. That said, with that kind of remoteness and that kind of perspective, I could say in 2017, it's really hard to differentiate functionality such that one institution could lend money and complete a loan, and another institution can underwrite a bond for the company, which may be the economic equivalent, but that's a security.
Right.
And so I think those issues I think the world has moved on, And by the way, all financial institutions around the world have dropped that dichotomy. So the U.S. would be a kind of island in the world, and I don't think it makes as much sense now. But I could understand and am sympathetic to the idea that certain of the functionality related to securities create a different set of risks than traditional lending. By the way, traditional lending is often the riskier activity. When you give money to your clients, as we do, you sit there and hope they pay you back. When you have a security on your book, and you get nervous about the credit underlying that security, you could sell that security in the market and liquefy your position. So it's kind of ironic that, and in the crisis, it was the kind of bank-like activity, not the security activity, that generated most of the losses.
I want to move on to your Q1 earnings. Big miss in trading. What was that down to?
Big miss in trading. It came down to a couple of businesses, namely our commodity business and our currency business. But we're looking at all those businesses, and the quarter before we outperformed in our trading businesses. This quarter we underperformed in it. Guess what? I'm happy to report that we're human.
Everyone else, though, this quarter in the US banks outperformed. So it wasn't a volume thing, it was a positional thing that you got wrong?
You know, when you look at it, the evidence that we have is that we underperformed in a market in which other people perform better. Now, some of that is attributed to business mix. Our client mix is a little bit different. We tend to deal with more, coming from our investment banking security roots, we tend to deal with more money managers and asset managers. It tends to be a higher proportion of our base. Hedge funds, we know that there's some stress in that and distress in that community. We tend not to have corporate money management services. We tend to perform fewer services for cash management, so our relationship to corporates tends to be a little bit less. That's something that had done very, very well during that because corporate balance sheets are awash in liquidity. That liquidity gets invested. So there's a bit of a difference in our footprint, but something that behooves us to even out that footprint and deal with and widen out our investor and client base. And we'll address these issues. We always have.
I want to move on and talk a little bit about Gary Cohn, if I may.
Sure.
When he was your number two, did he challenge you regularly? And do you think he'll be doing that now to President Trump?
I could confirm to you that it is a core of Gary's personality, which I've witnessed for 27 of the 27 years our careers overlap, that he's a challenging person. All terrific. He has great ideas. He's the person in my life who's said things that I've thought to myself, gee, I wish I thought of that.
Right.
He's very good, and I know I could just. I'm not that in touch, but I can see the relationship that he has with the president. I can tell that the president is right in bestowing trust on him.
Have you spoken to Gary since he left?
I have.
How many times?
Not a lot.
So you're not in regular contact with him or many of the other Goldman alumni in the administration?
No.
Well, what's your view on the fact that so many have, Steve Mnuchin, Dina Powell as well, have ended up in the administration?
Well, the first, my blink reaction is a sense of pride that, again, another person who wasn't necessarily friendly to our institution in his campaign recognized the talent of these people. I don't think he was going out of his way to hire Goldman Sachs alumni and current employees. I think he was looking for good people, and guess what? Disproportionately, he found them at our firm and in our alumni base. So I feel pride at that. It generates a lot of inconvenience for us because look at the questions you're asking me. Everyone, we're unduly, I think, apprehensive. Look, in the ordinary course of my life, we're an underwriter of debt. We're a very important and influential financial institution. I would normally be regularly engaged with the principal economic advisors and maybe the Treasury Secretary in any administration. A little apprehensive about it because for fear of how it might look. It creates issues for us that otherwise wouldn't be there. So in the one case, I'm proud. In the other case, it creates some inconvenience to us because it becomes a matter of news how many times, nobody's asked me how many times I talk to Jack Lew. And by the way, I talk to him frequently.
We've had a lot of challenges around the rest of the world, particularly in Europe over the last couple of years. Some elections have gone well for markets, others haven't. There's still some to come. When you look at that and the challenges places like Europe and Asia face, do you ever pause and think, gosh, I'm really pleased that the company I run and manage is based mainly in the United States and headquartered here, and the legal and constitutional protection you have in the United States?
Look, we're an American-originated firm, an American-based firm. But our business is distributed around the world. Our investors, our shareholders distributed around the world. Our employees, if you walk through the New York trading room, it's a United Nations, but we have trading rooms all around the world. So we're really a global firm. Certainly the U.S. there was a huge advantage being based in the U.S. It has a big balance sheet. So to the extent the banks were in distress, nobody thought it was going to blow up the balance sheet of the United States. That was never an issue. It was always the willingness of the United States and what they would be willing to do, not what they had the capacity to do, as it was in other places. And in general, the tone and the nature of the United States and the culture of the country is to get on with things and do things quickly. Look, it was pretty stressful for us dealing in the aftermath of the financial crisis. But the United States dealt with that aggressively. Firms were recapitalized. I could be critical of some aspects and some excesses of the regulation and the legislation, but largely they were good and necessary, and they were done right away. So we got on with things. So the regulation was done. We were able to adjust to it quickly. Firms were recapitalized. We're very well off. The U.S. firms are very well capitalized. Some of the firms in Europe are a half a cycle behind and are just recapitalizing now. And so I have to give credit to the official sector in the U.S. for accomplishing that objective very, very early in the process. It looked crazy to a lot of people who were watching from overseas, but guess what? The U.S. got it done.
Lloyd, I wanted to ask you before we wrap up about your health, if I may. In
sure.
2015, you had lymphoma. Are you back to full health, back to your best, do you think?
I feel pretty good. I have to plot it against the decline I get from just getting older than I was when I first got sick. I think I'm okay. I have very slight residual that reminds me from time to time, some numbness here and there. And then, of course, there's a little bit, I'm in the risk business. So I'd say there's a little bit of overhang. You worry about things coming back. But statistically, I'm cured. I feel pretty good. I don't think about it unless, except until I get asked the question.
Well,
so thank you for that.
Well, I apologize for bringing it up, but I'm delighted at such an upbeat response, Lloyd.
It's fair game.
We all are.
And you're terrific for coming here to our conference.
Well, it's been a pleasure to be here for your conference. And to round that off, I mean, you've been CEO for 11 years. Do you feel like you get better every single year from the experience and another decade to come?
Well, I feel I get older. I feel obviously you feel comfortable. I'm not sure whether comfort is good or bad, because I think, in the freshness and newness, you have different perspectives. I think there's value to experience. I've seen a lot of stuff. And there's also value to nervous energy and the freshness and the newness that one brings, and one has to weigh those things against each other. So I'd say it's great that I'm about to start my 12th year, because I got the call from Hank that he was going into the government Memorial Day weekend in 2006. As I get ready for my start of my 12th year, I think there's virtue to my long tenure. And one would have to say that it's not entirely virtuous, but I feel good, and I certainly have my energy about me.
And you mentioned that Gary used to challenge you a lot and think of things that you didn't think of. Does Goldman Sachs miss Gary Cohn?
Oh, sure. And we have other people who are also terrific, who aren't Gary, and Gary's not them. And Gary wasn't me, and I wasn't Gary. So I would tell you, he's terrific. There were things that Gary did that everybody wishes he was still there doing. But the guys who've stepped up into his job wouldn't have been there to do it if Gary was in that seat. So life moves on. It's a long gray line. My predecessors, I'm sure, were wringing their hands and saying, what's going to happen to Goldman Sachs with this guy Lloyd Blankfein in there? I've learned the lessons of history. I'm certainly not thinking that with respect to the people who are going to be around as my successors.
Lloyd, it's been a pleasure speaking with you today. Thank you very much for having us.
Wilf, and you're doing a great job. Good to see you.
You're too kind. Lloyd Blankfein, the chairman and CEO of Goldman Sachs. Guys, I'll send it back to headquarters.